Candlestick patterns. Candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable setups. A research have confirmed that candlestick patterns have a high predictive value and can produce positive results. I personally trade candlestick patterns. I'm going to introduce you to a holy grail. This trading system works, and candlestick patterns are the language of the market. Imagine you living in a foreign country and you don't speak the language. How could you live if you can't even say a word? It is tough, right? The same thing when it comes to trading. If you don't know how to read candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trader's behavior. This skill will help you better enter and exit the market in the right time. In other words, this will help you to act differently in the market and make money following the smart guy's footprints. The candlestick patterns that I am going to show you here are the most important patterns that you find in the market. But in this chapter, I'm not going to show you how to trade them because this will be explained in details in the next chapters. What I want you to do is to focus on the anatomy of the pattern and the psychology behind the formation because this will help you to get the skill of identifying easily any pattern you find in the market and understand what it tells you to do next. If you can get this skill, you'll be ready to understand and master the trading strategies and tactics that I'm going to teach you in the next chapters. So, the first candlestick pattern I'm going to discuss with you is the engulfing bar. So, the engulfing bar, as it states in its title, it is formed when it fully engulfs the previous candle. The engulf bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. The bearish engulfing bar is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. Bearish engulfing bar is when the smaller body is bullish, which means the market was buying, and the larger body is bearish. So the larger body is the one which is engulfing the smaller body. So on this one, the bearish engulfing bar, the market was moving in a bullish trend, and then it is now engulfed by sellers. So the market turned into a selling trend. So this is how a bearish engulfing bar pattern looks like on your charts. This candlestick pattern gives us valuable information about bulls and bears in the market. In this case of bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. So, on this picture, bearish engulfing bar is the one which causes the market to turn when it appears at the top of the trend. As you can see, when this price action pattern occur in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. You can't trade any bearish candlestick pattern you find on your chart. You need other technical tools to confirm your entries. We will talk about this in details in the next chapters. Right now, I just want you to open your charts and try to identify all bearish candlesticks patterns that you find. The bullish engulfing bar pattern. The bullish engulfing bar consists of two candlesticks. The first one is the smaller body and the second is the engulfing candle. Bullish engulfing bar. The price of the engulfing bar opens at the bottom and closes up. So the smaller body is the one which is being engulfed. The smaller body will be a sell and the larger body will be a buy. So The bullish engulfing pattern tells us that the market is no longer under the control of sellers and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents capitulation pattern. So this is the chart of a bullish engulfing. So the example above tells us clearly how the market changes direction after the formation of a bullish engulfing power pattern. The smaller body that represents selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What is important is that the smaller one is totally engulfed by the second candlestick. Don't try to trade the market using this price action setup alone because you need other factors to confluence to decide whether the pattern is worth trading or not. I will walk you through in another chapters. What I want you to do now is to get the skill to identify bearish and bullish engulfing power on your charts. This is the most important step for the moment. The doji candlestick pattern. So doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There is no one in control of the market. So doji candlestick pattern will be like this: price open and price close at the same time with these large wicks, the lowest price and the highest price. As you can see, the open price is at the same as the closing price. This signal means that the market didn't decide which direction will take. This pattern occurs in an uptrend or a downtrend. It indicates that the market is likely to reverse. So if this pattern occurs in an uptrend or a downtrend, it will indicate that the market will likely to reverse. So this is an example of a chart which have a doji candlestick. So the chart above shows us the market change direction after the formation of the doji candlestick. The market was trending up. That means that buyers were in control of the market. The formation of the doji candlestick indicates that buyers are unable to keep price higher and sellers push price back to the opening. This is a clear indication that a trend reversal is likely to happen. Remember always that a doji indicates equality and indecision in the market. You often find it during periods of resting after big moves. So we are on the dragonfly doji pattern. The dragonfly doji is a bullish candlestick pattern which is formed when the open, high and close are the same or about the same price. What characterizes the dragonfly doji is the long lower tail that shows the resistance of buyers and their attempt to push the market up. Closing price and open price will be likely at the same, but the tail will be long. So the illustration above shows us a perfect dragonfly doji. The long lower tail suggests that the force of supply and demand are nearing a balance and that the direction of the trend may be nearing a major turning point. So see the example below that indicates a bullish reversal signal created by a doji dragonfly. So this is a doji dragonfly. The market was selling, and when this doji candlestick was created and then the market reverses, start doing buying like this. So in the chart above, the market was testing the previous support level. That causes a strong rejection from this area. The formation of the dragonfly with the long lower tail shows us that there is a high buying pressure in the area. If you can identify this candlestick on your chart, it will help you visualize, see when support and demand are located, when it occurs in a downtrend, it is interpreted as a bullish reversal signal. So we move from dragonfly doji to gravestone doji. The gravestone doji is a bearish version of dragonfly doji. It is formed when the open and close are at the same or about the same price. What differentiates the gravestone doji from the dragonfly doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. So this is a picture of a gravestone doji that you will find in your charts. The open and the close will be at the same but with a longer tail. The image above illustrates a perfect gravestone doji. This pattern indicates that the buyers were able to push price well above the open. Later in the day, sellers overwhelmed the market, pushing the price back down. This is interpreted as sign that bulls are losing their momentum and the market is ready to reverse. And this is the chart for the gravestone doji. So long tail on top, opening price will be at the same as closing price. The chart above shows a gravestone doji at the top of an uptrend after a period of strong bullish activity. The formation of this candlestick indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. As a trader, you will need additional information about placement and context of the gravestone doji to interpret the signal effectively. This is what I will teach you in the next chapter. So, from the gravestone doji, we come to morning star. So, the morning star have three candlesticks: bearish candlestick and a smaller bullish or bearish candlestick and bullish candlestick that will take over the market. So the morning star pattern, it is considered as a bullish reversal pattern. It often occurs at the bottom of a downtrend and it consists of three candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge of the market. The second candlestick is a small one, which represents that sellers are in control but they don't push the market much lower, and this candle can be bullish or bearish. The third candle is a bullish candlestick that gave up on the open and closed above the midpoint of the body of the first day. This candlestick can hold a significant trend reversal signal. The morning star pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of downtrend near a support level, it is interpreted as a powerful trend reversal signal. So this is the chart for a morning star. Bearish candle, the market was selling, and a small bearish or bullish candle, and then the bullish candle. So this is the chart. The chart above help us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produced indecision in the market. The second candle could be a doji or any other candle, but here the doji candle indicated that sellers are struggling to push the market lower. The third bullish candle indicates that buyers took control of the sellers and the market is likely to reverse. This is how professional traders analyze the market based on candlestick pattern. And this is how you analyze financial markets. If you can master the anatomy of candlestick pattern and the psychology behind the formations. So from that morning star, we move to the evening star pattern. The evening star pattern is considered as a bearish reversal pattern that usually occurs at the top of an uptrend. So the morning star, it occurs at the bottom, the evening star at the top. The pattern consists of three candlesticks again. The first candle is a bullish candle. The second candle is a small candle that can be a bullish or a bearish. It can be bullish or a bearish, or it can be a doji or any other candlestick. The third candlestick is a large bearish candle. In general, the evening star pattern is the bearish vision of the morning star pattern. So see, this is the example of the evening star: a bullish candle, a small candle, and a bearish candle, which will take the market down. So the first part of the evening star is a bullish candle. This means that bullish bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that the buyers are still in control, but they are not as powerful as they were. The third bearish case that the buyers domination is over and a possible bearish trend reversal is likely to happen. See another chart that illustrates how evening star okay. So this is the chart of an evening star. If the first candle is the bullish and then the second candle is either bullish or bearish or either doji, and then the last candle which causes the reversal is the bearish candle. So this is an example of an evening star. As you can see, the market was trending up. The first candle in the pattern indicates a long move up. The second candle is a short candle indicating price consolidation and indecision. In other words, the trend that created the first long bullish candle is losing momentum. The final candlestick gapping lower than the previous candle, indicating a confirmation of the reversal in the beginning of a new trend down. So from that evening star, we go to the hammer. Pin bar is another example of candlestick. So the hammer candlestick is created when open, high, and close are roughly at the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market high. So this is a hammer pin bar. So closing price and opening price will be at the same, and on the top will be little or no tail, but on the bottom there is a long lower shadow. So the hammer is a reversal candlestick pattern. When it occurs at the bottom of a downtrend, the candle forms when sellers push the market lower after the open, and the rejection comes from buyers. So the market closes at the same time. Like see the example below. So this is a chart of a hammer pin bar at the bottom, causing the price to reject and the trend to reverse. So as you can see, the market was trending down. The formation of a hammer pin bar was a significant reversal pattern. The long shadow represents that high buying pressure. From this point, sellers was trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure, which result in a trend reversal. The most important thing to understand is the psychology behind the formation of this pattern. If you can understand how and why it was created, you will be able to predict the market direction with high accuracy. So from that hammer, we came to the shooting star, a bearish pin bar. So the shooting star formation is formed when the open, low, and close are roughly the same. So this candle is characterized by a small body and a long upper shadow. It is the bearish vision of the hammer. So professional technicians, they say that the shadow should be twice the length of the real body. See the example below. So the shadow is long enough, that is twice the body of the candle. The opening price and the closing price are likely to be at the same. So shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. The psychology behind the formation of this pattern is that buyers tried to push the market higher, but they got rejected by a selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. So, this is the chart of a shooting star bearish pin bar. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of the uptrend move and the beginning of a downtrend. So, this candlestick pattern can be used with support and resistance, supply and demand areas, and with technical indicators. The shooting star is very easy to identify and it is very profitable. It is one of the most powerful signals that I use to enter the market. So, from the shooting star, we came to the Harami pattern, the inside bar. So, the Harami pattern or continuation pattern. So, and it is consists of two candlesticks. The first candle is a large candle. It is called the mother candle, followed by a smaller candle, which is called the baby. For the Harami pattern to be valid, the second candle should be outside the previous one. The candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. So Harami pattern, bullish inside bar. So the first candle is the mother candle and the second candle is the smaller candle. Harami pattern, bearish inside bar, mother candle, and a smaller candle is the selling candle. The first candle is buying and second is selling. For bearish inside bar, for bullish inside bar, the first candle is bearish and the second candle is bullish. So as you see, the smaller body is totally covered by the previous mother candle. So don't bother yourself with the colors. The most important is the smaller body closes inside of the first bigger candle. The Harami candle tells us that the market is in an indecision period. In other words, the market is consolidating. So buyers and sellers don't know what to do, and there's no one in control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives us an opportunity to join the trend. And when it occurred at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal. So this is the chart in another scenario. In the chart above, you can see how the trend direction changes after the Harami pattern formation. The first bullish Harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly, price start consolidating, and this indicates that the selling power is no longer in control of the market. The bearish Harami is the opposite of the bullish. This one occur at the top of an uptrend, indicating that buyer's domination is over and the beginning of a downtrend is possible. When this happen, like when this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. We will study in details how to trade this pattern, either as a reverse pattern or as a continuation pattern in the next chapters. So from that Harami, we came to the tweezer tops and tweezer bottoms. The tweezer top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezer bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. Tweezer tops, this is an image of a tweezer top, bearish candle and a bullish candle. Tweezer bottom, this is an image of a tweezer bottom, bullish candle and a bearish candle. The tweezer tops formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick, and the tweezer bottom formation consists of two candlesticks as well. The first candle is bearish followed by a bullish candlestick. So we can say that the tweezer top and the tweezer bottom are likely to be the same. So the tweezer bottom is the bullish version of the tweezer tops. So the tweezer top occur during an uptrend when buyers push the price higher. This gave us the impression that the market is still going up, but sellers surprised buyers by pushing the market lower and close down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with another technical tools. The tweezer bottom happens during a downtrend when sellers push the market lower. We feel that thing is going all right, but the next session prices closes above or roughly at the same price of the first bearish candle, which indicates that buyers are coming to reverse the market direction. If the price action happens near a support level, it indicates that bearish reversal is likely to happen. So this is a chart showing tweezer bottoms. So the chart is showing us a tweezer bottom that occurs in a downtrend. The bears pushes the market down on the first session. However, the second session opened where price closed on the first session and went straight up, indicating a reversal buying signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of a candlestick. Try to understand the psychology behind the formation. This is the most important. So focus on the psychology behind its formation. This is the most important, because if you can understand why it was formed, you understand what happened in the market and you easily predict the future movement. So if you find this video useful, you can consider subscribe, as we are going to dive deep into candlestick formation and other technical analysis